Right, hello everyone. Today I've got with me Lyall Taylor, who is portfolio manager of the LTCP fund and also the author of the LT3000 blog, which I think I came across in 2019 and just, I don't know how I didn't find it soon. I've been an avid reader ever since and just got so much out of it. So just wanted to thank you so much for taking the time to chat with me.
Sure, my pleasure. Thanks for the invitation.
Yeah, so you're outdoing me for the background for once. Usually I've got trying to show off my surfboard in the background. Where are you?
yeah, I'm in Phuket actually. So after obviously a long hiatus of traveling, finally things are starting to open up, and I'm based in Singapore. So with now the travel restrictions on both sides easing up somewhat, I've been able to come across, and yeah, it's absolutely stunning. It's not a fake background. So it's been great. Just been working here on the road and having some vacation time the past couple of weeks.
Cool. Well, I guess probably start with some background for anyone that hasn't heard of you. So how did you get into the fund game to start with?
Yeah, I guess it goes all the way. I developed a real interest and passion for markets quite early, actually, towards the end of school, early university, and discovered Warren Buffett and read all the letters and that sort of thing. Started trading my own accounts. And I sort of always wanted to run my own fund. That was always the sort of end game that I had in mind. It's sort of a question of how you do it, especially these days where the barriers to entry have gone up. There's a lot of regulation and compliance and cost involved in getting started. So I ended up taking a bit of an indirect route. After I graduated, I worked as a sell-side analyst, actually, from New Zealand originally. So I worked with Macquarie for 4 years as a research analyst in New Zealand. And they transferred me up into Jakarta. So I spent 6 years actually writing research in Indonesia, which was a lot of fun. But at that point, I sort of got to the point where I had a means of basically exiting and setting up my own fund. So basically, I've set up a fund on a platform, which is the platform provider I use is Swiss Asia, who do all sort of the back end, compliance and middle back office, and you can basically set up a fund and run it pretty much as a one-man band. So I've been doing that for about 4 years now, and absolutely loving it.
Awesome. Yeah, that's the path I thought I might find myself taking. So I always love picking your brain on the ins and outs of it. I guess I wanted to start with something that you just completely kind of changed my mind on. From when I first read it, I realized I had the wrong worldview, and that was I'd always kind of harped on that the big difference between value and growth was often just duration, and that was the idea, which was gonna. Sorry, he'll wander back and forward behind me.
Not a problem.
But the main sort of my main focus was duration, and you've written some great pieces on the role of excess liquidity and how that's been one of the sort of almost the main driver of returns, and it can be used to explain kind of a lot of the sort of excess performance we're seeing in a lot of sectors. I was just wondering if you could kind of dig into sort of bigger overarching view with excess liquidity in the system.
Yeah, really good question, really good topic. I think the way a lot of people sort of think about these issues is sort of almost slaves to the idea of market efficiency. People don't actually think the market's efficient, but a lot of the sort of ideas that are associated with that concept are still factor into how people think about these issues. And so there's always a desire to perhaps overly intellectualize and explain things like why certain sectors like growth stocks essentially performing better. Why would they be impacted more by higher interest rates? And so you get these arguments that the longer duration cash flows mean higher discount rates disproportionately impact such stocks. And it's true to some degree, although that's actually only true if you're talking about higher real discount rates rather than nominal discount rates. But really, I think it's important to get away from the sort of overly abstract academic way of thinking about it. And in my view, sort of realize that asset pricing is actually a very concrete, real world thing. And asset prices are driven by one thing and one thing only, really, which is demand and supply. And if there's a lot of demand, if you create a lot of liquidity, if the Fed's printing a lot of money, the macro is basically a composite of all the micro effects. And the average investor, just every investor really has a certain amount of cash at their disposal, and they're looking for ways to essentially optimize how they invest it. They might want to have a bit of cash, they want some stocks or bonds or whatever. And you know, if you take the investment universe as a whole, like there's a finite number of assets that people can invest in, and there's a certain amount of cash that's basically floating around looking for a home. And the aggregate level of asset pricing is going to be determined by the interaction of these two factors, which lead to demand and supply. And this ultimately is what drives asset pricing. And these kind of notions of market efficiency, you know, you also see things. I wrote a piece about the tyranny of the numerator, where everybody's always describing, you know, markets going up or down to, you know, people are revising down growth expectations, or maybe that, you know, they think retail sales will be weaker next month or whatever. When a lot of the time, you know, it's the denominator, the cost of capital, which is the market clearing price. When you factor in that demand and supply that I was talking about, is actually often the larger driver of asset pricing moves. And it's very common. You know, there's an old saying that the definition of a bull market is a random market movement that causes the average investor to mistake himself for a financial genius. You know, and there's a lot of truth to that. And it really, to put, you know, some more beef around that, it's really the liquidity aspect. You know, if you're in an environment where there's excess liquidity, there's too much money chasing too few assets, there will be a bias for stock prices to go up, and that will create, you know, when that bias exists, it's very, very easy to make money, particularly if you're in the preferred sectors and the parts of the, you know, global marketplaces that are attracting those sorts of flows. And a lot of the time, we've seen it in spades the last couple of years, where people are ascribing these really strong performance numbers of some investing styles to, you know, structural growth, and to, you know, disruptive innovation, and to compounding growth, all this kind of stuff. And really, it's had far more to do with the fact that there's just been enormous amounts of cash that have been pouring in, and it has to go somewhere. And so, yeah.
Well, that's kind of like the because it cuts both ways, doesn't it? Like the prime example there is obviously Cathie Woods with ARK, where she had a lot of quite illiquid names. She started to outperform, received a lot more sort of inflows, and herself was kind of bidding up those illiquid names in like a big way. And it's kind of like it works both ways. Like I've done a presentation where I could see it kind of cutting against her the other way, like because she's been responsible for a lot of the inflows. It could also, when she has to exit, it kind of see that could play out in crypto, and could see that play out in quite a few areas. Is that kind of like a fair view, a fair assumption?
Oh, absolutely, because this links into the concept of, you know, of liquidity flywheels, which I've also blogged about. And this is, in my opinion, one of the biggest contributors to market inefficiency. And I think, I'm a believer that the market's not only a bit efficient, but profoundly inefficient. And basically what happens is, you know, if a fund manager, or, you know, a group of fund managers with a particular style or whatever, whether through good foresight or simply through chance, you know, go all in on a certain theme or a certain factor or style or whatever it is that performs well, then inevitably, like, strong performance leads to additional inflows. And, you know, what those managers are going to do is they're going to take those inflows, and then they're going to deploy them in across the board in the same stocks that they already own. And of course, this creates more demand for those very same stocks, and it contributes to pushing up the price, and then the performance looks even better. And so you get more inflows, and this sort of thing can go on and on for years. And, you know, we've seen it happening in the venture capital world as well, where, you know, there's some big money made, and this is really characteristic of long-term cycles in markets, where, you know, after the tech wreck, there wasn't that much money in venture capital. There was some well-heeled money, valuations are low, and there was some really big wins. You know, let's build back Facebook, etc. And so there was these really outstanding returns. And then, of course, you get a whole lot of people subsequently that come in that want to jump on the bandwagon and try to cash in on these returns. And the venture capitalists have been attracting more and more and more money. And as they've done that, despite the fact we've seen so many startups and so many there's still been an imbalance between the amount of money going into venture capital funds, particularly with the Vision Fund, you know, Masayoshi's son, just outrageous, 100 billion, you know, numbers, didn't mess around. He's like, why not add an extra zero? Why not? And there's been so much money coming in, and there just haven't been that many places to deploy it. So of course you just see a feeding frenzy, and the valuations just, or the prices, I should say, just keep getting bid up and bid up and bid up, and it becomes like a self-sustaining flywheel, where the inflows drive huge gains, and the huge gains drive more inflows. And this has happened many, many times. And what usually kickstarts it is, often it doesn't necessarily have to be, but normally it's associated with a certain thematic or new, something that's new and exciting, because that's what really gets investors excited and want to put money in, right? So if you say it's disruptive innovation, or it's the future is electric vehicles, or ESG and clean energy, or whatever it is, if it's a theme that will resonate with the end investor, it's worth remembering that the majority of the money that's invested is actually not the actual money of fund managers and fund management organizations. It's large, whether it's pension funds, etc., that parcel out allocations to high net worth individuals, or just individuals that have a little bit of savings. When you pull all that up, and if that's the majority of the money out there, and when it comes with this nice narrative and exciting narrative, it tends to attract money. And so, and if that money's coming in and there is growth and there's very good returns, it seems to validate the narrative. And so people say, look how smart I was. I knew electric vehicles were going to be a big thing, and I invested in an electric vehicle ETF or whatever. Now I'm up 100% in the last year. I'm so smart. And then they say, well, I'm going to put some more in, right? And this continues. And this goes on often to the point of morbid, just ridiculous excess. We've seen this happen many times, where what starts out as being pretty sensible, what the smart do in the beginning, the fools do in the end. I think might have been Buffett who said that. I'm not sure. But it ends up being taken to just ridiculous extremes, and eventually it just buckles under its own weight. And then when that happens, and I can explain, in more detail what that actually means from a more concrete standpoint. But once it starts going the other way, the whole movie has to be played in reverse, and it can get really, really ugly, and prices can eventually fall to unimaginable lows during the boom. This is a very common thing that happens in markets. It's the primary determinant of market inefficiency. And so that's my view on that.
Do you buy any of the kind of counter arguments to that? I was recently listening to David Hay, and he was saying, he's someone I respect, and I followed a lot of his sort of blogs and stuff. And he was saying in the next sort of heavy correction or crisis, he could see like the Fed stepping in and buying stocks. And so kind of come with this, I don't know if you follow like Kapi, he's got like the Project Zimbabwe, the idea that the systems, like whenever the liquidity is withdrawn, it's just going to come washing back in and everything will get propped up? Or is that just kind of like it's just delaying the inevitable, I guess? Or is it the idea of sort of a melt up?
Yeah, it's the latest iteration of the sort of Fed put argument, which is often disparaged, but it's actually not. That some of those disparagements are unfair, because the world actually has changed. Like in bygone eras, there wasn't anybody that would come in and rescue the market. But if you do have a central bank that on a moment's notice is willing to print money and buy assets to any degree to support asset markets to help the economy, then that really does reduce the scope for prices to get very cheap, and for the duration with which you could expect them to get cheap. I still think you'll have situations where people panic and stocks collapse. It's a question of like, how long do they stay cheap? But on that point specifically, look, I think it's going to depend. It's possible, but I think it's going to depend a lot on the inflationary environment. Now, what's happened in the post-GFC era is we were in an environment of basically, there are two types of economic environments problems that can exist. One where you have excess or inadequate demand, and one where you have too much demand, right? So if you look at this place like Turkey, the problem they've had is too much demand for the last decade. So actually the economy, it would surprise a lot of people, but the Turkish economy has grown, it's done just fine from a growth perspective, but they've had too much demand, and that leads to inflation. The problem that the West had after the GFC was inadequate demand. Okay, so you had a credit bubble burst, it was deleveraging, your consumers deleveraged for years, and when you're in an environment where there's inadequate demand, you can ramp up fiscal spending. In fact, arguably you should. This is a classic Keynesian approach. To some degree, certainly you should, perhaps, to support demand. but you could also, print money potentially, and it won't necessarily lead to an increase in demand that's sufficient to absorb that output gap and tip you into inflation. So what's happened over the past decade is we've had this environment of demand deficiency. We did some fiscal stimulus, did some QE. It still never really got to the point where there was too much demand. And one of the reasons for that is the transmission mechanism of the QE. The Fed buys bonds, and who are they buying bonds off? Predominantly investment funds and rich individuals. And they don't say, oh, now I've got extra cash allocation, I'm just going to go out and buy a fleet of Ferraris, or I'm just going to, they say I'm going to reallocate that cash to other assets, private equity, venture capital, put some more in stocks, etc. Right? Alternatives. So it did lead to asset price inflation, but not a lot of it actually trickled down to goods and services demand. Some of it did, but also that we weren't running until Trump, the deficits were sort of moderating as well. So that was sort of a demand headwind that was offsetting a little bit of it. And some of it started to flow through over time, because as you had a venture capital bubble and all that sort of thing, there's salaries being paid, all the losses these companies are making of money you're putting in pockets of people living in Silicon Valley that were going out and spending on real estate and cars and whatever. And so some of it did percolate down, but we never got to the point where we tipped it into a structurally excess demand situation. Now, this has changed in the last year or two with COVID, because what's happened alongside just this, already we had sort of closed a lot of the output gap before COVID. There was already a lot of it starting to trickle down. But what's different this time is we accompanied the huge buying with massive increase in fiscal stimulus and deficits. So we're talking double-digit fiscal deficits, which is really the highest ever outside of wartime and the absolute peak of crises like the GFC, etc. And that is tantamount to deficit monetization. You know what I mean? Like, a lot of people will deny it, but it is essentially deficit monetization when you ramp up government spending and the extra bonds being issued to fund it are being bought by the Fed. And what's happened now is that we have tipped it into an excess demand situation, right?
Up to money.
So yeah. And it's not just asset prices. Absolutely, without doubt, it's pushed asset prices up. But now real goods and services demand, with federal fiscal deficits contributing significantly to that, have meant we now actually have more demand than supply. And of course, when you do that, you get inflation, right? Now, with respect to the Fed stepping in and buying stocks and projects in Zimbabwe, look, I think certainly the Fed is behind the curve. The Fed is, afraid to take too much action too quickly because they don't want to derail the recovery and cause a big, but they are moving in the direction of tightening. And if we're in a situation where stocks are selling off, but you've still got inflation at 5 or 10%, I think it's extremely unlikely that they're going to start buying stocks like crazy with printed money. I think that they might consider doing that if we had another sort of debt deflationary bust like the GFC, where there's a horrific recession and we had no inflation bordering on deflation. I think they would consider that. I think they would first of all just go back to the old playbook of buying bonds. I think it would take quite a bit before they got to stocks, but it's not impossible they would do that. But I think in the kind of downturn that we're potentially facing now, where you've actually got inflation and you actually have to bring in demand, I don't think that's likely, and I don't think it's plausible, particularly now that inflation has started to become a political issue in the United States. So Biden's approval rating is down. Inflation is one of the reasons for that. So I think it's going to be very, very difficult for this sort of reckless money printing to continue in a high inflation environment. So I don't think that put is going to be there in that type of downturn.
Interesting. Do you often the pushback get when sort of say that the excess liquidities will be pulled out? Said, oh yeah, of course the speculative stuff will go, but the sort of the blue chips like the FANGMA will hold up. And you've kind of written, you don't think that'll be the case really either, like the sort of the kind of almost sort of excess expectations will weigh too heavily on them. It's just like almost like a price to perfection argument, I guess.
Yeah, I don't buy it. I mean, I think certainly the speculative stuff will bear the sharpest brunt, and a lot of that stuff will go down 90% plus. That's not going to happen with the FANG stocks. It's unlikely they go down that much. but they will still go down, as will the broader market. And the thing is, industrial scale levels of printing leads to industrial scale levels of flows into the largest, most liquid assets that can absorb that type of liquidity. And I think I saw an extraordinary statistic recently. I haven't actually personally verified it, but it's something like if you take out the top 5 performing stocks this year, the NASDAQ is down, sort of 25% or something of that magnitude. Maybe it might have been from the highs rather than the year to date. But yeah, this deterioration in breadth is often what you see at the end. And when there's just so much money going into ETFs, et cetera, and these big stocks are becoming larger and larger parts of it, it's also the classic thing that happens with active management. It's like you have to own these stocks, because if you don't own them, again, like if you didn't own them, you would have underperformed catastrophically this year, right? If you're a large index cycle. Yeah. And so the money, and another extraordinary statistic I saw, again, I haven't personally verified it, is that there's been more inflows into equity ETFs and funds this year than in the last 20 years combined, something like that. So if anyone who thinks that the mountains of Fed printing has not contributed to those inflows, and those inflows have not contributed to the fact that, the apples and all this kind of stuff are up 50% this year, Apple is I think diluting themselves. Like, now, to be clear, there has been very, very strong earnings this year from Microsoft, Apple, and Google. So there's some fundamental support to it, but that's not, again, like if you've ever invested, as I have, and I'm sure you have too, in environments where there's shrinking liquidity, you'll be well aware that it doesn't matter. It doesn't matter a damn if the fundamentals are great. The stocks still go down if there's a shortage of cash. So these stocks will go down, and there will also be second round economic effects. If you look at Apple, I mean, I don't really have a strong view, but they were making 50, 60 billion a year for a while, and then they suddenly made 90 billion. How much of that's due to the fact that people can't travel? They say, oh, maybe I'll buy a new iPhone, and I'm at home a lot, I'm using Zoom a lot, maybe I'll upgrade my iPad or get a new Mac. Is it actually going to hold it at 90 billion, or will it come back to 60 or 70? Who knows, but it's 30 times 90 billion now. And it's in downturns, there tends to be a decline in earnings as well as a decline in multiple, which is something that people often forget. So I think if liquidity tightens, certainly all the spec stuff will get annihilated. But I think all of the large and mega cap companies that have seen multiple expansion over the last year or two, will all go down by significantly, at least 20 or 30%, and maybe more.
I always love Lynn Alden used an example. I think it was Cisco, and she used one of their presentations in 2000, and everything they projected, sort of their revenue growth out to the future, where they would position themselves, it was all correct, and yet they lost sort of 85% of their value. It's just, people,
I think it's still like, it might even be like still at like half of what it was at the peak, even though earnings have gone up 7-fold. Something like, so and that's just, people just get really carried away. I mean, one of the things that often happens too is that Kathy Wood makes this mistake a lot when she talks about exponential growth. It's not exponential growth, it's sigmoidal growth. It's characteristic of S-curve is that they look exponential initially, but then they plateau and mature, and like the world is of a finite size, and you simply cannot compound at very high rates for long periods of time. And you think back to the late 90s, and you can imagine people saying, wow, the internet's going to be huge, it's going to change everything. And like Cisco had been growing earnings at 30-40% compound for the last decade, and the idea that we were going to like have excess capacity of fiber and networking kit anytime in the foreseeable future just seemed ridiculous. You're like, this thing is going to grow and grow and grow crazy for decades to come. So of course this company is going to grow and compound earnings for decades to come, right? But the thing is, but when the market caps get so large, it's like, look, yes, there will be a lot of growth, but you cannot just keep compounding off a large base of 30 or 40% for decades and decades. The numbers just get astronomically ridiculous. And I've made this point about Amazon many times. I've done the math, like in some of my Twitter threads and that, pointing out that, look, if you're just not doing the math, if you think you can get even a 10% return, I said this about a year ago, the stock's sort of been flattening off, even a 10% return, when you actually look at how much they have to earn and how much and distribute just to get you a 10% discounted cash flow, return. It's just like the numbers are just astronomically large. And so what happens, people just get too carried away and they ignore this. And eventually, of course, the growth starts to slow down, even for the very best companies. And Cisco is, there are many, many other companies that don't have the moat of a Cisco, where what happens is, their earnings quickly get hit by increased competition. And, there's just the disruptors become the disrupted. And that happens a lot. But even the companies with really strong moats, that take decades before there's encroachments, like Cisco's facing a little bit now from Arista. The price can just get so far ahead that even if the company does okay, but the growth just slows down, and as some of the maturity becomes evident, the stocks can still be a total disaster. And I think we're going to see a lot of that happen in the coming period. And the other thing that people forget is that in the long run, the new becomes the old. Like if you went back 20 years, it was unthinkable that a company like Intel could lose its dominance. You know what I mean? It was unthinkable. It was like Nvidia is today. It basically had overwhelmingly dominant market share in chips with the architect, CPUs with the brains of the entire computing internet revolution that was about to happen. And they had the biggest R&D budget. They could buy anybody that was a competitor. And yet here we are 20 years later, and they're still around, they're still a decent sized, very profitable company, but they've just been chipped away as time goes on. Same thing happened if you go back 20 years before that, IBM, same thing. And so the companies that seem, just so like, just so impossible to disrupt, like they're just going to always be dominant. It's always seemed that way, but things change over time, And NVIDIA, like I think it's an extraordinary company, and I have great admiration for Jensen and what they've done. But, no one really knows what the situation is going to look like 10 or 20 years from now, So if you pay up 100 times earnings in an absolutely booming gaming environment, AI, CapEx environment, et cetera, this is, that's a classic company where you could, 20 years from now, the stock could be lower than it is today, even though the company's been a phenomenal success.
Yeah, I love that line of thinking, because I've often, like one of my favorite magazine covers is a Nokia CEO, and it's got Nokia, who can catch him? And I think it was like 2006 or something around there. And so it's just, hard to possibly foresee that new technology coming. But it's also like, it sometimes feels like the crash is also necessary for the technology to advance. Kind of like if you used like anything based on streaming, you almost needed the .com boom to collapse so that all the fiber optics could be bought for cents on the dollar, and then that whole cost base come down. Is that like, I was thinking of trying to like draw a parallel with maybe with crypto, like some of this DeFi stuff obviously does have a use case, but it's kind of bundled in with, call it 95% speculation. So you need to wipe out that 95% speculation so that the functionality can rise. Is that a fair way to look at it, do you think?
I'm not so convinced about that. I think, had there not been a downturn, and what would have happened is you would have just laid more and more cable, right, for longer. And if anything, more capital flowing in is going to mean more spending on R&D, and so if anything, it probably slows it down a little bit. Yeah. But I do think that it's helpful to have a cleanse occasionally to get rid of the excesses, inefficient companies, etc. And certainly what it does is it rebases it to the point where the strongest companies will tend to benefit, because they'll consolidate the industries, becomes a much more, it lays the foundation for much healthier growth and returns, and purges a lot of the misallocations of capital and things that are happening. So from that perspective, it's probably good for economic efficiency over the long run, but I'm not so convinced that it helps accelerate. With that said, necessity is another invention, right? And by creating a tougher environment, perhaps it does have some benefits in that respect as well. But I think the case with Netflix is it was always a case of like, how long does it take before you get to the point where bandwidth is fast enough and reliable enough for large numbers of people to stream high DTV, on demand. And the internet was there 20 years ago, but it wasn't there with that degree of capacity, right, and reliability. So that's why there was a delay. I think it was always pretty obvious that it was going to go online. I know a lot of people say, Reid was a visionary and all this sort of stuff. But I really don't think, even, I'm not saying that with the benefit of hindsight either. I I used to cover Sky TV back in the late 2000s. So I was already writing about and talking about these issues. I don't think you needed to be much of a visionary to see that coming. That was pretty obvious. But it's just a question of like, how long was it going to take until the internet infrastructure was there? But yeah, I'm not necessarily convinced the downturn accelerated that. If anything, it probably slowed it down a bit.
I think everyone always like, I think I've read a few pieces where it's they just show that there can be multiple companies that were perfectly positioned, and some of them were just 2 years too early, as you say, like a sort of a YouTube. I forget who was prior to YouTube. Just had insufficient line speed really for video to take off at that point of time.
Right.
And then
that's right. You can be too early as well as you can be too early as well as too late. Too early is okay if you've got the capital to write it out, but if you don't, if you're too early, then you're going to lose money. If you run out of money, you go out of business.
Cool. Got along the same train of thought as this, with sort of trying to work out how it's going to play out. I just wanted to talk about greenflation as such, and so this is kind of digging into the whole renewable and EV space. I struggle to see it scaling in the way that everyone kind of forecasts currently, the likes of sort of Bloomberg and the IEA, and generally because of I always fall back on energy density and energy return on investment. But then the counter to that is always like the high prices that we're going to see is going to drive innovation, and you never want to be on the wrong side of innovation, kind of like the Malthusians, like you kind of but don't see innovation moving us forward, and you always kind of got surprised by human ingenuity. So I've just got the note here. It's just got energy return on investment versus ESG, like kind of like how do you view that? Do you think ESG will survive kind of higher inflation and a lot of higher input costs across the whole renewable and EV space, and we'll have to return to moving up like the energy density ladder? Or do you think innovation from those high fossil fuel prices will kind of allow it to scale with kind of the innovation, improving the technology?
Yeah, no, great question. It's such a big topic. It's hard to even know.
Sorry.
Look, the first thing I'll say is that in the very long run, Elon Musk is right that we're going to have to move to solar, because in the very long run, we are going to run out of fossil fuels, right? And unless we find a way to transition human civilization away from reliance on fossil fuels, then there's just going to be an epic collapse in civilization at some point when we run out. It's like, you imagine sort of a society that's kind of totally dependent on wood, and there's a big forest, and you're cutting down trees like crazy. And you say, we don't have to worry because there's still a whole lot of trees left. It's like, yes, but eventually you are going to run out, and then you're going to have a giant problem. And Musk is when he talks about sustainability, he's not talking about ESG. So, you got to be careful with your terms. He's talking about sustainability as in we need a sustainable source of energy or civilization is going to collapse. Now, he's right, but I think he's at least 100 years early, maybe 200 or 300 years early. But at least 100 years early. But that is kind of where things are going. Now, in terms of like how it's going to progress in innovation, it's certainly true that the Malthusian kind of experience shows that one does have to be a little bit cautious about making long-term projections, because it's possible to underestimate new innovations and new technologies. But it's also the case that I think people are because of what's happened in the extraordinary things that have happened in computing and telecommunications, etc. People are much too optimistic about technology now with respect to like atoms rather than bits. And it's not the same. Like, so people often draw analogies. They say, solar's, going to scale just like microprocessors, etc., and module prices coming down but it's energy is fundamentally different from microprocessors, because with microprocessors, what you're doing is you have the same transistor, right? And you're making it smaller, and you pack them closer together, and there's less energy needed to process and store the same information. So you can scale that, and you can get more processing and storage for less energy. but that's not the case if you're talking about like energy, which is, moving electrons, etc. You're fundamentally constrained by the laws of physics, right? And so, yes, we will develop new technologies. Yes, we'll make things more efficiently and all that sort of thing. But you can't have this sort of just blind faith, which a lot of people have, that innovation and technology will save us. Now, I think eventually, I actually do think we could move to fully sustainable, but the cost involved is astronomical, and it's going to take at least 50 to 100 years to do it. And a lot of the time people focus on solar and wind, and they say, the economics are there or thereabouts. Often there's subsidies involved and all that sort of thing. But, rich societies could probably afford to function just on solar and wind. However, like, people are excluding the cost of energy storage. And like, you simply cannot function, a modern society cannot function with intermittent energy. And it's not just the day and night cycle, it's also the seasons. Like, this is one of the biggest problems for solar, is that you'll often, in the northern southern hemispheres, you often get 3 times as much sun in the summer as you do in the winter, right? And you often need a lot of energy in the winter. And so, the problem is more than just storing energy over spreading it through the day. It's also, getting through the winter. And really, we don't have any practicable mass storage technologies that can be done at the sort of scale needed. Probably the most viable is going to be pumped storage, where you just build huge reservoirs, you pump water up, and then you let it out. But these are massive infrastructural projects. These are projects that will cost, will take decades to build and cost like hundreds of billions of dollars to do a scale. And then there's a tremendous loss of efficiency. You lose about 25% efficiency loss just pumping it up and releasing it and that sort of thing. But it could be done. But it's going to take a very, very long time, and it's going to cost a lot of money. And in the meantime, it's often forgotten, right? You pointed out that a lot of people forget it. Is that 6 billion people in the world still live with a small fraction of the energy consumed by developed economies, and they're growing and they're developing. And so when you put together, population growth and average rise in energy use across the world, you're actually fighting. You're not trying to basically move the sustainability of a constant level of energy. You're chasing a moving target, and even just even catching up, even offsetting that growth is going to already be a very difficult task. On the other point of whether higher inflation interest rates will affect the economics, well, potentially yes, because the largest cost of renewables like solar and wind is the capital cost, right? Because aside for operations and maintenance, there's no feedstock cost, right? So if you were to increase significantly the cost of capital, the cost of solar would double, triple. If the interest rate is 7% instead of 2%, the essentially the all-in levelized cost would triple, right? Because essentially capital cost is the only material input.
Quite leveraged. So yeah, I think quite a few of the projects are quite leveraged as well. A few of them I've seen sort of 75% debt to equity to make the IRR work. Is that so? Yeah, just hurts it even more.
Yeah. So I think the way I see it is that yes, like we'll continue to see these kind of mandates and everything, and we'll slowly, in particularly the developing world, be moving in that direction. But overall, it's going to be a very slow process, and people that think that fossil fuels are going away anytime soon, I think are going to be disappointed.
Yeah, because I've been watching Germany out of interest because I feel like they're the furthest out on this. I was just watching I don't know if you follow Doomberg, but he put out a piece recently, and he's been focusing in on the new chancellor, and he's like just adamant that they're going to close down all the remaining nuclear facilities without really having any means to kind of replace it. Same's happening in California, and just makes me wonder if like everyone's going to kind of be viewing these as the pilot program at the same time, pilot scheme, sorry, at the same time that we're going to have rising energy costs, food costs across the world, and that could actually kind of turn the ship as such on this whole movement. Like ultimately, everyone that keeps pushing for this is going to keep inflicting more pain on their voters, and ultimately people will vote in someone that's going to have a more pragmatic, like like a French type 70% sort of nuclear mix. They see that they're not getting the same sort of pain that Germany is, and sort of that reality kind of turns us away from the energy transition and turns us in a funny way back towards sort of higher energy density sources. I'm quite positive on the outlook longer term, because I think kind of the next gen nuclear could possibly have like hot electrolysis. You could produce hydrogen, you could produce fertilizer off that, you could run cars, no need for fuel cells. But then I also think I wouldn't have seen a lot of this going as far as it has in the likes of California. I wouldn't think they'd shut down another nuclear power plant when they're already having blackouts. So I wonder if I'm just being optimistic and I'm still going to be horribly wrong in another 5 years. I don't know.
Look, I think what you're saying is it's possible, but I think what has to happen is you have to have a serious crisis.
Yeah.
Because like, from what I've observed, there tends to be a tremendous amount of inertia in terms of the policy regime that exists, not just with energy and climate, et cetera, but all kinds of social policies. And the system can actually tolerate quite a lot of inefficiency. You know, like there are big governments around the world that are just giant engines of value destruction, right? But you still see, you know, there's a vigorous enough private sector that, you know, it's sort of like I always conceptualize it as somebody sort of walking up a cliff with a big boulder on their back, you know, and it slows them down. But if they're strong enough, they can still walk up the hill. And this is what the private sector does and has done for the last 100 years plus. And the boulder keeps getting a little bit bigger, right? But you can still push you out. So unless you have, if you just have sluggish growth and social problems and things like this, if it's not really bad, it just tends to muddle through. And I think this is because most people don't have the time like you and I do to sit around and think about these things and debate these things all day. Most people are busy just living their life, and problems are often misattributed, right? Politicians will always cast the blame on other things. So, recently people have been blaming, the high gas prices in Europe, and they say this shows why we have to have more renewables, et cetera. So the blame will always be deflected, and things will be imperfectly understood, and the current sort of zeitgeist will continue. But if you have a catastrophic collapse in people's living standards, then that leads to radical disillusionment. And then what happens is people are open and willing to consider completely different ideas. So people that stood up and said things that would just be totally ignored and dismissed in ordinary times, people will actually be open to listening. And so, if that's where people, the people that are saying things like, climate change it's not really that big of a deal. We're fundamentally dependent on fossil fuels, high energy costs, and crimped living standards, all this kind of stuff. That nobody pays attention to people like that, right? Or if they point out all the problems or the challenges, people just don't listen. But if you had a major crisis and somebody stood up and say that, you could actually get some momentum behind that, right? And then they could come out and say these idiots, turned off all the nuclear plants. What are they doing? And people will be like, yeah, what the hell were you doing, right? But the Western countries aren't, like in places like California, Germany, aren't ready for that. So I think what's going to happen is, and I'm not necessarily saying there will be a major crisis. I'm just saying that I think the muddle through scenario is more likely, and what we see is more of the same, and we see slower growth and some impact to people's living standards, etc. But it's sort of more of a muddle through scenario than any dramatic change would be my prediction.
Okay, and kind of my worry as well is what I'm seeing now is a lot of the developed countries are making choices that are just going to inflict a lot of pain on developing. So sort of like you and I, it doesn't really matter if food prices go up 100%. Like if we're with all the sort of take fertilizer prices at the moment going sky high, like that's going to have a knock-on effect. Is that going to? Because just trying to work out how to word it. Like it's what would the effect be of like food and oil going absolute vertical, sort of say the middle of next year on the back of higher fertilizer prices. So it's probably a safe bet to say food's going to go quite high. going to be quite damaging to developing countries, and oil prices sort of drive it all up, saying that the developing countries will still be able to sort of shrug it off and say we've got to stay with this is just a price to pay for sort of the transition, and it's kind of all worth it to continue kind of inflicting pain kind of across the board. That's sort of the muddle through. You don't.
Well, I mean, it could be an unintended consequence. In fact, to some degree, it's already happened to much less kind of extreme. It could be an unintended consequence of what the West is doing, particularly pressuring oil and gas companies to spend less. But will the developed countries really care? I don't think so. It's human nature, right? But look, I don't think it's going to be that bad. It's already hurting to some degree, but I'm still pretty confident that there are enough organizations and companies out there that respond to price signals and invest. Like in Russia, there's big, very efficient fertilizer companies that are investing more, expanding capacity, and this. I don't think we will have a situation where we will get runaway kind of prices. I think we'll have high periods when the supply will come on. It'll come down. The prices might stay up, particularly oil and gas prices might stay up a little bit, but I don't think it's going to be enough to create a massive crisis in the developing countries. Also, they do grow a lot of food, and it's also worth remembering that a lot of the developing countries are actually net exporters of a lot of commodities too. Like typically, the poorer the country, the more they rely on natural resource exports, and they import sort of like machinery and services, things like that. So it's also, it sort of cuts both ways. But you've already seen it's had an impact on inflation throughout the developing world, and most developing countries have had a pickup of inflation. Very few are struggling with what Turkey's struggling with, because that's a domestic policy issue of excess demand. But there is a flow-through impact of higher oil prices and food, fertilizer, etc. That's raised inflation across Africa and other emerging markets, and Central South America and so forth. But I think we're already well into that, and it's absorbable, I think.
Yeah. Something I've wanted to ask you for a while is just on sort of inflation psychology. Like, I think people always kind of underestimate it is kind of a psychological phenomenon when it sort of takes hold. And I've always wondered, now with the world kind of being connected sort of via social media, and the kind of effect that could have, like, sort of, to use an example would be, I don't know, someone posting a picture of a Big Mac going up 20% on Twitter, and it goes viral around the world, and everyone rushes out and sort of buys more Big Macs. It's kind of that sort of reflex. Do you think that could have a sort of a bigger effect on inflation this time around, or do you think?
No, I don't. I actually think the psychological aspects of inflation and deflation as well are grossly exaggerated. I think it's got far more to do with monetary conditions, and simply whether you have, this is where the fiscal and all that comes in, whether you have an excess demand or an excess supply situation. And in an excess demand situation that leads to inflation, I think what tends to happen is inflation becomes sticky, not because of expectations. This is what always is argued, it's inflationary expectations. Of course, inflation, when you look back in the data, will correlate with inflationary expectations. But it's not the inflationary expectations that's driving the inflation. It's inflation that drives the expectations. And I think what actually happens is there are many prices that are linked to CPI. So you have, there are a lot of contracts that basically adjust prices to inflation. There's regulated prices, whether it's like natural gas pipelines or electricity bills, et cetera, that have CPI linkers, and like a lot of government entitlements, et cetera, are linked to CPI. And so what happens is if you have CPI running at 10% for a while, then all those prices start to adjust at 10%, right? And then that starts to feed, then the prices are passed on, and then that feeds back into even more 10% inflation. And then typically, if you're in an excess demand environment, you'll have strong employment markets, not necessarily. And that means, employees basically say, I want at least a 10% pay rise, I'm going to go down the road. And I think that's what leads to inflation becoming sticky. And of course, if you're in that environment, the way people form their expectations is based on their own personal experience, right? So if you see prices going up 10% every year, if somebody asks you, what do you think inflation is going to be next year? You'll say 10%, right? And so I don't think that's actually the fundamental driver. The other thing is that people, like in a really hyperinflationary environment, like one where week to week or even day to day money's losing value, like in a Venezuela or Zimbabwe or something, of course, you'll try and get rid of currency as fast as possible. But if it's just an environment where there's like 10% inflation or something like that, people, for their investments, they'll try to get out of cash. And we've seen some of that already. People will buy whatever, stocks, crypto, real estate. So it inflates asset prices. But when people are doing their monthly budgeting, right, they've got to pay the rent, they've got to buy the groceries. As long as the cash is not, the value is not just completely disappearing in a hyperinflation environment, I don't think it really affects consumptive decisions very much, actually.
Yeah, that's cool. Hadn't thought of it that way. I guess people will be annoyed if I don't start asking you about some more sort of investment related stuff. So yeah, where are you seeing value in the world in the moment? Like geographically, how would your portfolio be split up? Just sort of a rough percentage sort of breakdown, I guess, of where you're positioned in the world currently with some of your investments.
Sure. Yeah. So I mean, the two axes are sort of like geographic and sector, right?
Yeah.
And so value against the cluster where I'm invested, which hasn't really changed a whole lot anytime recently. But I've got about 30% in Russia, actually, and about another 10, 15 in the former Soviet republics and sort of peripheral countries around there, as well as like Georgia, places like that. And I think that's an extraordinarily good place to invest. Just really, really incredible value and a much misunderstood and neglected part of the world as well. And, like I've got some investments in Kazakhstan, for instance, and, like not to be confused with Afghanistan. And when a lot of people would probably be surprised to learn, for instance, that Kazakhstan's actually grown at about 5% a year over the past 20 years, about the same pace as Indonesia, not too far behind India, and has a GDP per capita, pushing sort of $10,000, so significantly more developed than India and Indonesia. And yet it has none of the exciting sort of growth narrative, the emerging consumer narrative, that places like India have, where people pay extraordinary multiples for, emerging consumption, etc. And so these sorts of places actually have some really interesting companies, really good companies, often less competition because you haven't had a flood of capital when everybody chasing, raising money and trying to get in. And some growing economies with solid macro fundamentals. Russia, tends to be significantly misunderstood. And there's been a sell-off recently, which is a fantastic opportunity to have a look. The rest is sort of spread. I've got 10, 15% in US and Canada. I've got about 15% in Hong Kong, China, which I think is also a very prospective place to look at the moment. I've got about 10% in Europe or something like that, and then the rest about 10, 15% in Africa, actually, where there's for the brave and the intrepid. There's actually some really interesting opportunities in Africa at the moment as well. Very liquid, so only very difficult to access as well. Not an easy market to invest in, but there's some interesting opportunities there. So that's the geographic. In terms of sector wide, I said the value is really in financials, selected financials. You have to be a bit selective. US large cap banks, etc., not that attractive anymore, but there's still some sort of mid tier, well, not really mid, still quite large companies, but not the mega cap companies. Some of the financials there are still reasonably attractive. The energy sector is cheap globally. Telcos here and there, although it's a structurally deflationary industry, I'm not a big fan of it generally, but here and there there's a little bit of value. And so, clustering sort of in oil and gas, particularly some really good opportunities there, even in spite of the fact that it's come up a bit. In traditional energy, I think is interesting. So clustering around those sorts of things.
Are you going more with direct producers or you service stocks when you're going into commodities? Because it's kind of something I've been wondering a lot about, but we're seeing a lot of rhetoric about sort of putting super taxes on, like you've seen Biden obviously kind of go after a lot of producers. But then again, I guess you don't have that rhetoric in a lot of the like Russia and stuff. So is it more just the large producers and they're not really hobbled by ESG in a lot of ways, I guess?
Yeah, I mean, my oil exposure is predominantly Russian oil and gas companies, but I also own CNOOC in Hong Kong, which is very, very cheap. It's particularly because US investors are not allowed to own it. There's an executive order barring US investors from holding it, and they're forced to divest. So it's actually very, very good company and very, very cheap. And I've also bought Petrobras recently, which is also now, it used to be a very badly run company, very corrupt. They've changed management. They've delivered the company. They've taken a lot of costs. They've sold a lot of non-core assets. And now they're paying out 60% free cash flow now, and sort of trading less than 3 times earnings at $70 oil. And those are my preferences. But yeah, the big Western oils are subject, actually, ironically, to more political risk, I would argue.
Yep.
But I would still probably own things like Shell and BP, which are, in the absence of superior opportunities elsewhere, I think those are quite cheap. The US oils are a bit more expensive, but I think that they will. It's sort of like the tobacco companies, like they've still done really well. They've had to deal with lawsuits. They've had to deal with, constantly increasing regulations and taxes. But ultimately, if there's fundamental demand for their product and the supply side economics are okay, that you'll still, and the valuations are low, you'll still get a good result. And I think that will probably be the case for the Western oil companies, particularly as, that an associated consequence of them being pressured into more ESG is that they're likely to, and they are in fact, being a lot choosier about their upstream capex and shrinking their project portfolios, etc. So you'll have less supply coming through, which will help. And people also forget that they have large natural gas businesses as well. It's not purely oil. Natural gas is going to be around and an important fuel for a long time. So will oil, of course, but natural gas is seen as a transition fuel. That part of the business is not going obsolete. So so I think they're also quite good investments. If I was confined to large cap, mega cap developed markets, I would probably own BP and Shell, maybe Chevron, Exxon, maybe not.
And when you say financials, is that just purely banks, or are you looking at insurance companies, or are you looking in any? Is it what's the sort of?
Yes, selective. I mean, you have to be very selective with financials. But like I've blogged about it in the past. I've owned Capital One Financial for a long time. Just a very, very well run bank, and it's come up a bit. It's come down recently, but these are still companies that good returns on capital, conservative leveraged and run. Very thoughtful. Fairbank is a very thoughtful. If you ever listen to him present, he's a very prudent, thoughtful bank executive. And a lot of these companies, because they weren't allowed to buy back shares and pay dividends during the past 2 years, they've been retaining all their capital, and they took large provisions up front. The losses never emerged. They're writing them back. So a lot of them are sitting on huge amounts of excess capital now, and so they're starting to buy back shares. And so they've got, if you strip out sort of the excess capital which they're now deploying into buybacks, you're still buying these things like mid to high single digit P multiples for fundamentally very sound businesses. And so I'm still quite content to continue to own companies like that. But yeah, I owned Bank of America and these kinds for a while, but I've sold them now. They've run up. I think they're fairly valued now. Not expensive, but I'm not a big fan of the European banks, but some of them are still quite cheap. But generally, the net interest margins are very low, and they've got a lot of leverage, and the margin for error is pretty small. And so paying sort of a 7-8 times P for, like 7-8% ROE banks, 10-15 times leverage, is not loans to equity, is not super compelling. But I have been active in some European banks in the past. But I owned ING for a while after it sold off. I've sold it now and made some money on the Greek banks. I made some money on the Italian, a little bit of money on the Italian banks. I've owned Lloyd's for a while. But generally, the large cap banks in developed markets are not that interesting anymore. I think that where the real value is in banks in emerging countries. It's select emerging countries, because often actually they're very good businesses, and they're still, like I tweeted a little while back, a chart from one of the African bank, that I was looking at, and they're lending at 10%, and their cost of funds is 2%, right? And so this is still, these are still very, very good businesses, and in a lot of these markets, the market is consolidated. there's only so many large players that got big economies. Banking is a scale business. If you've got economies of scale, etc., you can invest in technology, invest in network, etc. You're strongly positioned. And these banking only really becomes a bad business when you're in an excess capital environment like what Europe has been in. Where there's just so much excess liquidity and NIMs get compressed to an insane degree. That the US banks have escaped some of it because they have large and very profitable, investment banking operations and institutional broking and asset management, which are good businesses, cyclical but very good businesses. But the plain vanilla banking is really tough when you get interest rates squeezed. But you're not going to be dealing with a excess liquidity, excess capital environment in places like Africa and that for a very long time. And often these banks have very low leverage and yet are still very profitable, and also have very significant growth potential. And so there are risks, of course, around them, but you can often find some very good investments in that space in select developing countries.
Is that so? It's mainly banks that you own in Africa, or is that a sort of?
No, I've got some. I've got a bit in Africa, but like in Russia, in Kazakhstan, in Georgia. It's a little bit riskier in Georgia, but one in Indonesia, and there's a few more scattered around. But you have to be selective, right? You have to look at the risks, the macro risks and imbalances, as well as the company-specific risks and imbalances. But yeah, banks has sort of been put in the too hard basket by a lot of investors since the GFC, and a lot of people simply say they're black boxes. It's impossible to understand the risks. It's actually not the case. It's particularly for banks that are relatively vanilla in their orientation and relatively low leveraged. Banking crises don't just come out of nowhere. They're preceded by significant build-ups and imbalances, and which, if you understand how the macro works and how these problems can emerge, very seldom happen unless you've had a bubbly sort of run up and you've got excessive reliance on short-term funding, you've got large current account deficits and these sorts of things. And if those things are absent, the bank's very profitable and low leverage, there's actually not much risk at all if it's well run, prudently run.
Just reminded me of a conversation I had with Tim Stamos, and he was talking about high quality businesses across Africa. He's a big fan of the sort of exchanges. And have you done much work on exchanges and the way that they're kind of an interesting business model is they're quite sort of asset light, help defend against inflation. They almost benefit from volatility, I guess. Like you can, even if you're in a sort of a pretty brutal sort of bear market or something, trading volumes will still increase and sort of make revenues. Just wondering, have you kind of dug into them as sort of an asset class?
Yeah, I love stock exchanges. Usually they're very expensive. If you look around the developed markets, you'll be paying 30 times at least, 40, more than 40 in some instances. But at the right price, stock exchanges are really fantastic businesses because it's a natural monopoly, right? As anyone who trades knows, you want liquidity, right? Like anyone who wants to trade wants to get filled as fast as possible at the best price. So of course, everybody goes to the venue where there's the most liquidity, and that's a self-sustaining thing. It's very rare that a stock exchange gets disrupted, and it's a business that it's not 100% free cash flow because there are some regulatory requirements, and there has to be some collateral, some margin in the clearing if they own their own clearinghouse, etc. But for the most part, it's 100% free cash flow business, and it can grow as the economy grows. So as the economy grows over time, and as asset markets develop, you will see a larger amount of assets, and that you also see more trading in those assets, and they're a natural beneficiary of that. And so, yeah, stock exchanges are great investments, and I own a few. I own Moscow Stock Exchange, which is it's trading 11 or 12 times earnings, and it's actually it's a very well-run company. People have a lot of assumptions and prejudices when it comes to Russia. One of the most important things with investing is that you always keep an open mind. And, I think if most people went and had a look, they would actually be stunned at how well run the company is, at how developed Russian financial market infrastructure is, some of the innovative things they're doing, the transparency and disclosure, capital allocation, etc. And this, and you're buying it at a time where asset prices in Russia are, sort of generationally low. Really, they have been for a while. But you're not, you've got low market cap to GDP, low, bond, etc. to GDP because interest rates are still high and everything. So that's a very, very attractive long-term investment, I think. And as you point out, they actually benefit in the short term from increased volatility, although it's not necessarily material. But it's structurally good businesses, and I own a couple in small size in Africa as well. Some of the ones that Tim's talked about are also in the Nairobi Stock Exchange in small size, but they're very small, very liquid. You have to be patient. Stock exchanges are fairly unexciting to own on a day-to-day basis. They tend to grow slowly. 5-10% a year. They don't grow like 20 or 30% a year. So it's not going to be to everyone's taste. But I think just as long-term, cash rooted business is very attractive.
Yeah, well, it's we chatted a while ago, and it was I still remember talking to you about like how the game sort of feels at the moment. Like if you've been responsible, you're not really focusing on getting some crazy multiple expansion. You're just focused on cash flow, and it'll kind of take care of itself. Like I was like buying some coal companies and buying them at sort of 1 times like EV to EBITDA, and like can't really see how I go wrong with that. Like sure, I might never get some multiple sort of expansion, but don't really need to when you're kind of getting quality businesses. And is that kind of how you're viewing a lot of stuff you're going into? Is it ever you're kind of looking for more of a sort of inflection, or you're just always focused on sort of just the sheer sort of free cash flow and how much it's going to return and just compound that way?
Very much the latter. I mean, I've got a couple of things I'll say about that. The first is that in the long run, all stock returns are fundamentally driven by the dividends paid relative to the price paid. So it's only during intermediate periods of time where you get re-ratings or returns that don't necessarily bear any relation to the cash that the company ultimately pays out, right? And this is the thing, stocks are long duration assets. It takes many decades for the cash that a company is going to pay to ultimately be paid out. But you could actually work out with precision what your return is. You could take every stock today, right? You could come back in 1,000 years, probably every single company that exists today is gone. And you can work out exactly how much cash was paid out, compare it to today's price, and work out exactly what the IRR was, okay? And that is ultimately what determines the return in the long run. Now, in the short run, as we know, stocks can go up and go down. They can re-ratings, de-ratings. And of course, most people are not investing with decade-long horizons, and they're not prepared to wait for their returns. They want to make a return this month or this year or this quarter. And so the whole market is focused on, catching re-rates and getting. But I mean, this is one of the reasons why Warren Buffett's been so successful, because he's known right from the start. He's been very clear about that's what drives returns. So if you remain focused on that, you will ultimately, as long as you're appraising the cash flows that come out correctly, you ultimately are going to get a return that reflects the cash flows that the company pays out. And I might add also that a lot of people focus on the cash flow to the firm, but I actually don't focus on that. I focus on the cash flows to the shareholder, because I think it's actually a very important difference, particularly for companies that are not well governed or that have poor capital allocation. Ultimately, you don't control the company. So what matters is, what's the stock worth to me as a holder, right? And what it's worth to me is, if I buy it, what cash am I going to get? And I can assess how much cash I think I'm going to get. And then I work out what I think the IRR is based on the share price, very approximately. And I buy the things where I think they have the best cash flow IRRs. And if you do that, there'll be volatility. Some years will be up or down. But ultimately, if you're getting that math right and you're owning things that generate high cash flow based IRRs and you hold them, you're going to make high returns. And the ability to do that and to not care about the volatility and not care about short-term returns, even over 1 or 2 or 3 years, is a rarity in markets. It gives you a very significant edge. The second thing I'll say about that is that there's two parts to investing, right? There's return and then there's risk. And what happens during raging bull markets, like we've recently seen in tech and growth and all that, is that people become singularly focused on return. And you can notice this when the biggest risk that people focus on is missing out on profits. So they'll say, oh, if you make an argument that it's expensive, they'll say, oh, yeah, but people said that, 50% ago, and what if it keeps going up, and what if it does, what if it does this and that and that? It could justify the price. It could justify twice the price. It's like you're more worried about missing returns than you are losing money, right? And this is when you get into this phase of the cycle, you'll start to have all people come out saying Warren Buffett's old-fashioned, Warren Buffett doesn't get it, etc. And that's because if you're singularly focused on return and you perceive all this return, you completely ignore risk, then old school value investing and Warren Buffett style investing seems very old-fashioned and excessively conservative. But of course, there's also risk in investing, right? And making sure that you're not overpaying and you're not exposing yourself to the risk of like catastrophic losses if you misappraise what the future looks like is also an extraordinarily important part of investing. And it's usually only when you go through like bone-jarring downturns, like happened after the dot-com bust, where a lot of investors lost 80 or 90% of their money, right? That people will go, actually, risk is actually pretty important as well. And that's often when the value investing aspect comes back, because value investing is a fundamentally defensively oriented approach to investing, right? You want to make sure you're getting enough for your money, you're not exposing yourself to the risk of large, on a portfolio level, to a large, permanent loss of capital, and you're exposing yourself to upside, great, growth, fantastic, great businesses, compounding, great, fantastic, but you don't want to be getting exposure to that at the cost of risking losing very substantial amounts of money. And because we haven't had a big downturn yet, a lot of, and also a lot of the new investors that are coming in haven't really experienced one because they're inexperienced. There's a lot of money that hasn't really learned that lesson yet, and it's a lesson that every generation of investors needs to relearn the hard way. And this time will be no different.
At the moment, everyone's just comparing dog coins. Yeah, it's I was thinking when you were mentioning some before, I guess the ultimate risk when you're in a lot of like picking on like Pakistan, I guess, was like currency risk. Like that's the one that jumps out at me is you get your numbers spot on and then you just get absolutely smashed on the currency. I'm guessing you don't try and hedge it out. That'd be too costly. Do you just kind of accept that as a risk? Is it sizing that kind of helps manage that risk?
Yeah, I don't hedge it, but I actually tend to think it's not just more costly, but in many respects actually riskier to hedge it.
Yeah.
And the thing is that this is a really great question, by the way, because this often comes up with investing in emerging countries. The thing is, currency weakness is not something that just happened. Like it's not like a random variable that happens. Right, there are very specific, there's very specific dynamics that drive it, right? And the most important one by far, especially in the long run, is inflation differentials. Okay, so if you own a currency that has 10% inflation in a country with 10% inflation, and you're comparing it to a currency that has 0% or 1 or 2% inflation, such as until a few years ago the European Union, etc., or the US. Then you should expect that the currency is going to go down by about 8% a year, right, as your base case. And if it doesn't, then the real exchange rate will be strengthening, even though the nominal might look flat. And if the real exchange rate strengthens, then of course what happens is exports become less competitive. You get more imports, the trade and current account decline, and then when you're more reliant on inflows of foreigners to fund the current account, there's more vulnerability to downward pressures if those inflows slow. And ultimately, it will, in fits and starts, come through in currency depreciation over time. So it's not the only thing that drives currency, but if you're an investor, that's by far the most important and the thing that you should focus on. And so the way you deal with that is that you factor inflation in to your basically into your valuation. And by the way, this is a mistake I see a lot of investors making, particularly when they go and invest in India, often quite sophisticated investors, like large institutions that you think would have thought this through. But, they'll go and they'll say, oh, I want to go, I want to buy HFTC Bank or whatever, right? And they look at it and it's at 20, 25 times earnings. And they're like, yeah, but it's growing at 15% a year and it's got 15, 20% return on equity. But you look historically, India's had like 5 to 10% inflation, right? So the way I look at it and say, okay, well, let's say it does have 15 to 20% ROE. The real return on equity is only about 10%, right? And then you look at the price of the book. Price of the book's 4 times. Okay, so what you're actually doing is you're paying 40 times real earnings. Okay, and the way that will manifest is your local cost of capital, 15, 20%, whatever, should be offset by an expectation of a currency loss of 8% to get you to a 7 or 8% hard currency cost of capital. But a lot of the time, investors fail to make that adjustment, and they will price it off a cost of capital that assumes that there's no inflation differential, and you'll see often significant overvaluation when that happens. So basically, you have to focus on that. You have to focus on inflation differentials. You have to focus on whether the central bank is independent and is running tight monetary policy or not, and and what the risks are around that ceasing to be the case. You have to look at how they're managing their economy fiscally. Is there a culture of fiscal prudence or recklessness? If there's a combination of fiscal recklessness, volatile politics, where sort of left-wing populist governments, tend to get voted in with a certain degree of regularity, as is often the case in South America, and perhaps not the most independent hawkish central banking, then you're running the risk of a big inflation cycle. And that's going to come through in significant currency losses if that happens. Okay, so that's how I think about it. There's a few other things, like if a country's singularly reliant on oil, like in the case of Nigeria, for instance, basically singularly reliant on oil as an export. If the oil price halves, you should probably expect that the currency is going to approximately halve or drop very significantly. But if there's a reasonable amount of diversification across exports, really inflation is the big thing to watch out for.
Just while I'm on risks, I was just thinking, so you said you've got some investments in Hong Kong and China. How are you, like with what we've seen with them pretty much putting some of the tech stocks to national service, if you will? Does that kind of impact your kind of outlook there, or are you just sort of in sectors that you don't think the CCP will kind of interfere, or how are you thinking about that as a risk?
Yeah, I don't know any of the China tech stuff. I haven't. I would at the right price, but all these risks, it's ultimately always a matter of price and probabilities. Yeah. But one of the things that is happening in China is that they seem to, from my assessment, they don't mind companies making reasonable amounts of money. They don't like freewheeling capitalism and excesses and too much money being made. And like some of what they've done was I was quite surprised what they did with the tutoring companies. I thought that was a lot more aggressive than I expected. But if you look at what they've done with the tech companies, a lot of it is actually fairly sensible at antitrust type regulation. And even with ants, people say that they've kind of, they've just, but a lot of what they're actually asking them to do is, to take 30% of the risk themselves on balance sheet and things like this are actually not regulations that lack a reasonable basis. So I think the regulatory risk is manageable, and there's also been the case that in some instances, like there was a recent announcement that they've decided to hike the regulated coal price or the targeted coal price, and also some port tariffs because the returns are a bit low, and so they've hiked prices to try to rebalance the market and stimulate a bit more supply. So a lot of what the Chinese regulators are doing strikes me actually as being very sensible. But it is a source of risk. The regulation is a source of risk everywhere. It's not as if in the West we don't sometimes have capricious and aggressive regulations. So I think it's manageable. And if you own sectors that aren't over earning, I think that's a big one. There's not a tremendous amount of risk from that.
One question I missed before, which is kind of quite a big overarching topic, and feel free to pass on if you will. It's just I've always sort of wondered if you could assign, like with this excess liquidity, I might be overreaching, but like the sort of the wokeism that we're seeing around the world is do you think you can assign that to it in a way, sort of like easy times and easy money are kind of leading to a lot of this trend, and that it could reverse with tighter money, or do you think that's just a far-fetched concept?
I think it has to do with an oversupply of what you could call an activist class, right? So we've pushed to get more people into university education, right, in the West, which is generally a good thing. But there's only so many people that are getting engineering degrees, math degrees, computer science degrees, and so forth, STEM, which have practical economic value, right? And we need doctors and lawyers and lots of things. But there are a large number of people that are getting degrees in these kind of social science kind of topics, where there isn't an obvious sort of career path in terms of actually producing value in the real economy, like goods and services, right? So a lot of these people are essentially, one of their only job or career paths is to become an activist, and so you have these activist organizations, etc. That to justify their existence, there has to be there have to be issues to rally against, right? There have to be things to get upset about, huge problems in society, systemic problems that need to be addressed. Now, I think with activists, if they have a good cause, like Martin Luther King and all this sort of thing, if they have a good cause, then they will take the good cause, right? But it's sort of a problem with progress, really. It starts to happen when you solve a lot of the problems and you start to run out of legitimate problems. And so what will then happen is you'll start to invent problems, right? So you've started to see, like the Southern Poverty Law Center, for instance, which designates people as, engaging in hate speech and all this sort of thing. One of the problems that they have is that there aren't enough obvious racists. And like the Jesse Smollett thing, and like what's been happening with how the media responded to some of those events. Like I forget the name. There's Rittenhouse recently, but there was that kid with the hat that happened a couple of years ago. I forget the name of it, but whenever there's even an inkling of sort of racially motivated violence, particularly by somebody white or a Trump supporter, the media is like all over it and covering it. There's an undersupply of actual racial violence and racists relative to the large number of activists. So anything just sort of gets amplified because they're all desperate for a reason to justify their existence and their funding, right? So like it's helpful to have some activists for causes, but if you end up with an imbalance where there's too many people trying to work as activists and social, and not enough things to actually be legitimately concerned about, you will have a grievance inflation, right?
I love that.
And I think that's fundamentally what's been driving wokeism. Is that like you have to keep, you fight for gay rights, so then you get gay rights. You're like, well, what are we going to do now? It's like we'll fight for trans rights. So you fight for trans rights, and then what are we going to do now? So they have to keep finding something else. And the problem is because society's become more and more liberal and tolerant, like they're running out of causes, so they have to keep escalating it. But to come back to your question, how much does it have to do with monetary policy and all that sort of thing? Well, like I said, there are legitimate problems. People tend to focus on those. If there's not, we kind of seem to invent problems. It is a problem with prosperity and privilege, where there's too many people. We're funding too many people to get degrees that are non-productive, that can work in non-productive roles, that can make a lot of noise, that can be a burden to society, not produce anything. And we can support that and fund that. But like I said, it goes back to the analogy of the rock on the back of the productive economy. The system can actually support a lot of inefficiency almost indefinitely. And so would it all stop? Times would have to get really, really bad. And then I think that's when you can kind of hit a reset button and people, but I don't really see that happening. It could at some point, probably will at some point, but these things tend to have an institutional momentum behind them that is more self-perpetuating than self-correcting. And that's what we've seen. So I'm not optimistic it will stop. I think it will continue and probably get worse, actually.
That's a great answer. What I've been wondering about that for a long time. Just going back to like just what sector are you most sort of interested in at the moment? What's your current like rabbit hole that you're going down? It doesn't have to be investment, like it could be, be others.
Well, I'm very much a bottom-up guy, so I will own any stock in any sector in any country, provided that I think the risk reward is attractive. And then, as part of doing that analysis, obviously understanding the broader sector context, etc. But because value tends to cluster, I tend to emerge with sort of exposures to certain sectors and countries. You have to obviously manage the correlation risk. But yeah, like I think that there's still a lot of value in the traditional energy space, even though it has come up a bit. It's come up at very, very depressed levels. And so I still like that, like say in financials and certain places, particularly incumbent market-leading banks that are investing in technology, etc. They have scale and consolidated markets, and a lot of these structurally growing emerging economies that are unhyped, that there's not a lot of excitement about. I think are also very good investments. But I have all kinds of sort of random positions: small cap, medium cap, large cap. I own a company in Australia called National Tire, which is a tire distributor, and they've been consolidating the market, making really great acquisitions, just really, really cheap, really good management, and stock's been doing well. They just announced another acquisition, and so like I own but these are all very kind of individual kind of situation. But I think Hong Kong is an area where the market's just been wrecked, like pretty bad. And this value stocks have just gone from cheap to cheaper, and not in the fashionable sectors, but there's just some really, really obvious stuff to own there, and it's not that hard to find. So I think that's worth looking. There's also it's quite a bifurcated market actually. There's still a fair few very expensive companies. And then some of the tech stocks have come down quite a bit. Some of them are still pretty expensive, but there are other sectors like old economy sectors, quote unquote, where there's quite a lot to do there.
I think you used up an hour and a half of your time now. So is there anything I missed? Is there anything you would have liked to talk about that I've skipped over?
No, we've hit on a lot of good topics. Great. Getting pretty warm out here as well. So.
Yeah, need to let you go for a swim. Yeah, thank you so much for coming on. I really appreciate this. Yeah, I think you're one of the people I wanted to sort of dig into the big topics with the most, because I love your writing, and I know you think about all this stuff so deeply. So yeah, thank you so much for coming on.
You're very welcome. It was a pleasure. Really enjoyed it.